Good evening. Thank you for joining me here for the financial do's, don'ts, and maybes for Americans living in Australia or returning, Aussies living in or shortly departing from the United States back to Australia. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists. Let's get into it. All right. So, first of all, I'm always very clear in saying that this is not personal advice. If you are looking for actionable personal advice, you would be well advised to engage with a suitably qualified financial planner or CPA who knows about these matters. Okay, a little bit about me, and I promise I'll keep it to a little bit. Tri-citizen from Brisbane, originally went to UQ, moved to the US 15 years ago. Started down the CFP and CFA route. I got my CFP and made it as far as level 1 in the CFA exam. Anyway, continued on. Founded Arete Wealth Strategists 7 years ago, and I've been growing exceedingly quickly for the last couple of years. Regular conference speaker, been quoted in a few places. I'm also the founder of the Global Financial Planning Institute, which exists to train other financial advisors so that they can work with expats and provide them with proper, comprehensive, and fiduciary advice. Okay. Who do we work with and what do we do? There's a brief explanation right there. Okay. Outline of tonight's presentation on the do's side. Here's what you do want to do in the US. And I'm going to try and be clear with each one of these where someone is geographically located because they do differ a tiny bit. But first, we'll go through and talk about investments. This is definitely an area where the US has a strength relative to Australia. Tax-deductible retirement accounts. That really is with reference to those folks that are in the US, not so much if you're in Australia. There are a few circumstances it does happen where you may contribute to a US retirement account when you're in Australia. Not so common. They do exist, however. Term life insurance. This is one of those things where if you can obtain it in the US, then the recommendation is go ahead and do that. US tax returns and informational filings. This is a tough one because it refers to both. This is when you're in the US, but also if you are a US person, and I'll define what a US person is, but if you are a US person abroad, then you must also continue to do your US tax returns and make your informational filings because the US, there is a long arm of the law that will that could reach out to you, and it's not a pleasant arm. It's not there for a stroke or a pat. It's not going to be pleasant. Don'ts in the US. Don't cash out your retirement plan prior to your retirement age. Now, this applies to everybody in the US, especially those that have been here on visas that have been here for more than 183 days. Why? Because you are considered, by virtue of the substantial presence test, a US person for taxation purposes. This also, and most pointedly, applies to American citizens back in Australia. They might say, gosh, I want to get my retirement plan out. Well, you can do that. You're just going to get hosed with taxes if you do it. Roths 529s, don't contribute to these in the US and certainly don't do them from abroad if you're planning to move away, unless you enjoy leaving a tip for the IRS. Short-term real estate, we'll go into that, look at a scenario, and I have to be very careful there. Something that has been missing from our language for a number of years now, nuance, highly specific to the circumstances. And I've created a case study I'll run you through where I hope to make that point a little more powerfully about short-term real estate. The definition I use for short-term is kind of less than 5 years. I tend to be conservative, especially when it's recommendations with my clients' money. And so I say 8 years, unless that you really think you're likely to be there for 8 years, then you might think twice about it. Illiquid partnerships, that's a really easy don't. Same with self-directed IRAs. Maybes in the US, why do we have this third category? Because sometimes things do make a lot of sense. Cash flow positive buy hold real estate, investment real estate. Now, that's a no-brainer. If you're here in the US and you're staying for a long term, why wouldn't you? Makes all the sense in the world. this specifically, why it's a maybe, is because if you're back in Australia, there's now some overhead, there's now some admin, there's more management filings, it's complicating your taxes. There is a burden that wasn't present for you as acutely when you were in the US. Deferred income annuities. I actually love deferred income annuities. I'm a fee only. My firm's a fee only advisory firm, so we don't receive any commission for that. I love them because they make sense, and I hope to make a believer out of you before we're done here tonight. Now, they're a very specific kind of annuities, and annuities are many and varied, but this is a very specific kind. And lastly, we'll talk about cash value life insurance and why that's a maybe on the list. All right. With that, let's get into it. So first off, we've got investments. This comes from a Morningstar study. Every 2 years, Morningstar puts together this global fund investor experience study, and they go through and they look at a whole bunch of different criteria. There's 4 of them actually, interestingly, the most recent one, that it got too complicated, ends up being hundreds and hundreds of pages. This report. And that they only did the fees. They have provided some updates here in 2020. But with regards to the overall performance, the US comes out number 1. Australia comes out tied for second place. But as you heard me say before, nuance. There is devil in the detail. Most specifically, Australia is head and shoulders above on the cost front and disclosure front. I was saying this to a client just last week. I said, the US is so good with their disclosures, we can find out where our fund managers went to school with the right databases, and we have those institutional databases. But that being said, the US is a market-driven economy, and there are good financial advisors and there are not so good financial advisors. And in Australia, with FOFA reforms of the Royal Commission, they've really improved the regulatory platform. And so I'm very proud to say that in Australia, we've seen the birth of financial planning as a profession. And I mean profession by the Webster Dictionary definition of that, meaning just as qualified as accountants, doctors, or lawyers. You now must do an actual undergraduate degree in financial planning to call yourself a planner in Australia and pass a rather rigorous ethics exam. No such thing in the US. However, I will say in the US's defense, there are what are called registered investment advisors who, since 1940, have been required to be fiduciaries and act in their clients' true best interests. Okay, fees and expenses, US and Australia are number 1. But there is quite a bit of blue sky between these expense ratios that we're about to see in just a minute. Also, the study, because they really have to just focus on managed fund investors. They don't get into other things like taxes, platform fees, or trading fees. Let me see here. So you see a 30 basis point, 0.3% difference in the median expense ratio here for allocation funds, and quite a substantial, 0.64% on equity funds. That is a huge difference, especially when we compound that over time. So while Australia was ranked in that top category, it's important to note that there is a significant numeric difference in the actual fees that you're paying. If we project that out over a 25-year period, you'd see here with a hypothetical $100,000 portfolio that equates to $60,000 lost to fees while investing in Australia. The other thing here is that there's significantly less product available, 212 ETFs versus 3,132. What else? So here are some pros and cons. I got rid of, I felt bad, but there wasn't time to update it. I got rid of the cons. There were some cons here on the US side, but there's no way they weren't really relevant, because there were things like, US has a global tax system, a citizenship-based global tax system. Thus, if you're a US citizen or green card holder, then you'll always be subject to US taxes no matter where you are. That's really not going to affect or change the fundamentals there to do with expenses, because it will apply regardless of whether you're in Australia or not. Okay. Other considerations, really important. I've done a whole nother webinar. In fact, even wrote a white paper on the topic because it's that important. It's a fast way to put people to sleep, to start talking about passive foreign investment corporations, but super duper important. In a nutshell, a PFIC is a non-US domiciled mutual fund, managed fund, same thing. Anything where 75% or more of the assets are held for investment, or where 50% of the income comes from what's called a passive source, you will get hosed with your US taxes. It will, if you aren't out and out hosed, then you'll get hosed by your accountant for filing the PFIC form. So in either case, no one likes to be treated that way. So we tend to avoid them. And there are ways of investing to get around it that can get pretty involved. Currency hedging is another matter. Home bias, what's that mean? This is a universal behavioral bias. We all have them. And that is people, I live in the Midwest. I'm here in Minneapolis, and there's actually a mutual fund here that is the perfect exemplar of home bias. They invest in Minneapolis companies, would you believe it? So there's Hormel, the makers of Spam, there's Best Buy, there's United Health, there's Target. It's it's the ultimate home bias fund. So it's very important for Aussie investors to watch out for home bias, given that Australia represents 2% of the global market capitalization. We don't want to be overexposed to Australia anyway. And the other thing here is rebalancing and managing a portfolio across borders can get rather tricky. Moving on. Second do in the US, let's keep this positive momentum going here. Tax-deductible retirement accounts. When you are in the US in particular, and when you're in the US on a visa in particular, I absolutely love them. And it's an easy recommendation to make, to say to a client, if you're here on a visa, you intend on returning to Australia, or not going onto a green card. And there's a whole nother presentation on the HEART Act. Go have a look at that. I believe it was September of last year. I did a webinar talking about the HEART Act. You don't want to be counted as a covered expatriate, because you get to pay an exit tax on your way out the door if you've been here for more than 7 of the past 15 years. That's a mouthful. Okay. So let's quickly run through the taxation of US retirement accounts. Looking, mostly folks have got 401ks. So the contribution on the way in 2020, and in 2021, I learned yesterday, the amounts were just published, that employee contribution is $19,500, as much as $56,000 if you happen to be self-employed or own your own business. Post-tax contribution, you can actually make contributions post-tax. We don't like that, especially if you're going overseas, already are overseas, unless you enjoy double taxation. Employer contributions, great, we love that. They're going to grow tax-free. That account growth is tax-free. This is all while you're in the US, please. This is while you're in the US. This does not apply once you've left. The taxation totally changes if you're back in Australia, because the ATO doesn't. They look at this and they say, this is not a superannuation account. What is it? Well, it's a foreign trust. We're going to tax it like a foreign trust. So we'll hold off on that. We're coming to that in a minute. So the distribution phase, the way it works if you're a US person or a US tax resident, is you're going to have to pay ordinary income tax subject to the progressive tax scale as we go through the rates. And we'll look at those actually in just a minute on the don'ts. So if you are a US employee in Australia, it may make sense to max your retirement contribution to reduce your Australian tax. So I heard some wonderful news yesterday, probably the best news I've heard all year, and there's been a lot of good news, a lot of bad news too, I might add, but certainly wonderful news. We got a flight back to Australia, moving back to Australia for about 2 years. I'm going to run my business from there. But I certainly consider myself a permanent resident here of the United States. So I am truly living this. I'm going back there. I'm going to keep my 401k, and I'm going to max that account out while I'm there. So you heard me say this a minute ago, don't make post-tax contributions. We'll get to that. There's a whole don't on that. And account growth, if you're simply an American in Australia, it may make sense to keep some or all of your retirement account in Australia, given the lower costs. Meaning, well, firstly, we don't want to cash it out early. That's a big no-no. But what I'm saying there is that given the first point about the lower cost investment environment, there may be other benefits to keeping those retirement accounts in the US and not prematurely moving them over to Australia. One of my favorite clients in Australia is an American lady who's accumulated a sizable 401k. And when I made her aware of this, that in fact it's a lower cost environment, we can invest it more flexibly, and furthermore, it's going to be taxed as ordinary income when you move it back to Australia, given that she's an American citizen. She realized, gosh, maybe it would make sense to progressively distribute that account rather than just move it all lock, stock, and barrel and get hit with a much higher average rate of tax on that, because that whole lump sum would progress up through the tax scale. Okie doke. And speaking of the retirement contribution limits, this is what we see in 2020. Up to 200, we won't worry about all of these. Really, we want to pay attention to that one right there, 19,500 for 401ks. That's going to be applicable to most folks here on the call here tonight. Dues in the US, another one that I find easy to recommend, and I do it with a clean conscience. Again, fee only, not receiving any commission. I do this because it makes a ton of sense, as you're about to see. So I find that a persistent cultural attitude from Aussies, and I understand it. I'm an Aussie myself. They love their life insurance in super. They just love it. And they love it, I think, for two reasons. One, they're not paying for it from current cash flow. There's that, again, another behavioral bias. If you're not paying for it out of current cash flow, it feels like you're not really even paying for it at all. Oh boy, yes you are. Yes, you are paying for it. The other reason that Aussies like their life insurance in their super is because the premiums are tax deductible. So both of those things are true. You're not paying for it out of current cash flow. And indeed, those premiums are tax deductible, but US term life insurance tends to be way less expensive, which offsets that tax deductibility. So it's so much so, you'll see in just a minute, I pulled up some quotes from earlier today. And that benefit, I found this out the hard way. Sadly, my mother passed away when I was 20. Came into a death benefit, and lo and behold, the ATO was there to take 15% of that, given that it was in a super account. So I have no clue as to what their reasoning is behind that, but it doesn't make a whole lot of sense. The societal benefit of having life insurance is that you provide a death benefit to the beneficiaries and that you don't tax it on the way through. So that's a huge advantage that the US has, is that in almost all instances that anyone on this call here tonight would be in, that benefit is going to be tax-free. There are some circumstances involving corporations, where the corporation is the owner, or if you happen to be of sizable wealth, and I mean sizable, so 11 million for an individual, getting closer to 23, it's 11 million and change, 23 million for a married couple before you're paying US estate taxes, 40%. So it's a pretty nasty tax, but like I mentioned, there's got to be a bit of wealth there before someone's on the hook for that anyway. So I ran some term life insurance quotes using my trusty calculators. I went to Quotacy, and the other one was finder.com.au. I'm not endorsing them. I'm just telling you which ones I used in case you're wondering when you see this. So what I did is I ran $1 million US dollar, 1.4 million, to get an equivalent currency adjusted amount for a 40-year-old Mr. Average, 6 foot, 180 pounds, non-smoker. This will be indicative, and we could run quotes all day long because they're different for everyone. So here's what we're seeing. We're seeing anywhere from $27 up to $31 per month. This is in the US. This is in the US. And importantly, this is really important to note because it changes it. It makes the US seem even better. This is for a 10-year term. So that's locked in. So from when this guy's 40 to 50, that price is not going to change. Let's look at what the exact same thing is in Australia. Well, by golly, look at that. $62 to $64. Let's go back. 27. So maybe that's more like $36, $37 Australian. Well, we're dealing with a massive discrepancy, almost double. And that's what I've seen throughout the decade that I've been a financial advisor is it's just way more expensive for life insurance in Australia. And I don't know. I would love to know the reason why. There are some theories out there as to why that is, but I don't know for sure. All I know is that it is way more expensive. And the beneficiary is taxed. So you'd have to, if you were to truly do a side-by-side, you'd actually have to not just currency adjust, you'd have to tax adjust as well. So you'd have to get more like an additional 15% on top of that 1.4 million to truly get an equivalent death benefit. So huge difference right there. Final do in the US, and I wish this was more about delivering good news, a carrot rather than a stick, but this is more a stick. But better informed than not informed. So keep in mind this webinar is focused on Americans in Australia or returned Aussies or soon to be returned Aussies. So if you're a US person, we have to use that term of art, US person, because it's kind of a catch-all term. You're a US citizen, for one. You're always a US tax resident. We're trying to really define what a US tax resident is. So you're a US citizen, you're a US green card holder who has not yet submitted their Form I-407 to officially terminate tax residency. I heard a horror story just last week from a tax attorney friend of mine who told me of someone who'd been away for as long as 20 years and had not submitted that, and then found that they were on the hook for 20 years of US tax returns. And then, I kid you not, literally as soon as that presentation finished, I got an email, a question from someone, and she said, I have a client, they got their green cards in 2016. They happen to be from Qatar. I don't work with people from Qatar. I work from people from Australia, as you all know. But anyway, she said, you know about international stuff, so I'll ask you. This person, they got their green cards in Qatar, issued in Qatar from the embassy, moved to the US, but didn't move, traveled to the US for a month. Then they moved back to Qatar, and they haven't been back since. What's the story with their US tax obligations? Congratulations, they owe US taxes, or they owe the returns at least. We can't make any mention of whether they actually owe any taxes or not, but they owe those returns dating back to 2016. Why? Because the US practices citizenship-based taxation, which means if you're in Australia and you're either a green card holder or a US citizen, you owe and must report on, you are assessable and must file a US tax return, as we're about to see in just a moment. Or in this case, if you're still in the US, and it really doesn't matter, it actually, and I'm dead serious about this, it doesn't matter if you're here on a visa, temporary visa, L1, E3, whatever the case is, or even here illegally for that matter. That's a fact. If you're here for more than 183 days, then you are a US tax resident, regardless. So that being the case, why is this important? Because from our friends here at the IRS, this, as I said, this is particularly focused on the folks abroad, because taken straight here from the IRS, if you're a US citizen, the rules for filing income, estate, and gift tax returns and paying estimated taxes are the same whether you're in the United States or not. Not very nice at all. And also not very nice are the penalties that apply with FATCA and FBAR. Now, these are known as informational reportings. So typically no tax associated with it, or at least they're checking to see that you're paying the appropriate tax given these types of accounts. But FATCA, there's a pretty high threshold for reporting on FATCA. It's much, much higher than FBARs. There's a whole table that applies to that, and it depends on whether you're in the US or not, whether you're married filing jointly or not. But from abroad, married filing jointly, it's pretty high. I believe it's up to $600,000. You would have to file Form 8938. And again, these penalties are very, very harsh. I tend to think of them this way. I tend to think of them like breaking a minor infraction of the law, a misdemeanor on the street. The police presence maybe isn't as strong as it once was during the era of COVID. And that is, if you jaywalk, are you breaking the law? Yes, you are. Are you going to get caught? Probably not. Is it still a crime? Yes, it is. That's the point here, is that, and the penalties are a lot higher than what they would be for jaywalking. So the point here is that it's best to be compliant and avoid a very, very unpleasant letter from the IRS. Okay, next, don'ts in the US. Don't cash out your retirement plan prior to retirement age. I think most folks know this. The thing with the IRA, the US 401ks and IRAs and so forth, and one of the reasons that Australia doesn't treat them like superannuation accounts is because the ATO took a look at them and they said, well, this isn't like super at all. You can get your money out at any time, which is actually not true if you're still working for a company. Is anyone still working for a company who has a 401k? No, you simply cannot get it unless there's some sort of hardship exemption. That's a topic for another time. But in any event, if you finish with an employer and you have the ability to roll the account, you also have the ability to cash out the account. The trouble here is that you're just going to get hosed with taxes. So you heard me say earlier, I would bring it back to this. Here's the progressive scale of taxes that we pay here in the US. So for a single filer, you'll see they're a lot lower than what, and the thresholds are higher than what they are in Australia. But of course, as we all know, this is only federal tax. Now, I don't get into state taxes here because folks are likely listening to this in places such as Washington State, Texas, Nevada, and so forth, Florida, that don't have state income taxes. So we don't get into that, but we need to think of that as well. Because if you don't, and that's a whole nother topic for a whole nother time, but if you live in a state where, and you haven't properly expatriated from the state, then it could be that the state of California is coming after you to get their 9.3 or whatever, depending on your income bracket. They're after their Gavin Newsom will be sending you a nasty gram wanting his fair share. Okay. So really the point here is that while you can get your money out early, if you are a US person, and I want to underline and state that, you don't want to do it because you're going to get hosed. You're going to pay an additional 10% and it's going to be paid. Let's just go back and look at an example for a minute. If you had a $500,000 401k, for instance, and you were single, then you're going to be paying 35 plus 10, 45% of that account would be your marginal rate. Now, you're not going to pay, of course, all of that. You'd pay that 207 and then 35% plus 10, 45% above that 207 amount up to $500,000. In any case, it would not be a pleasant day once you saw what remained of that account. Okay, there is an exception there, but it's another conversation for another time. Don'ts in the US. Now, if anyone here had said, I love the US, many, many, many things to love about the US, I want to stay here for the rest of my life, I'd say fantastic. Then we should have a conversation about how Roths and 529s, if you have children or you're thinking of going back for education yourself, how they might feature in your plan. However, if you're thinking of moving back to Australia, or already have moved back to Australia, then these should hold no part in your tax planning or investment planning. And the reason is one I'll get to in just a moment. So these types of accounts, they're typically, with the HSAs are not in this presentation, as you'll note, because they are tax deductible on the way in. But all these other types here, you see post-tax non-Roths, Roth IRAs, Roth 401ks, 529 accounts, they all have their place in pure domestic American planning, but that's not what we're here to talk about. So they're made with post-tax contributions. If there's an employer contribution, then it is eventually going to be subject to ordinary income tax as well. Account growth is tax-free, comes out tax-free, and I put in that little circumflex there with reference to 529s and HSAs. I deleted HSAs, but with 529s, if you use it for qualified education expenses, then that money will also come out tax-free. So wonderful for folks that really view themselves as US domiciliaries. That word in itself requires a definition. So you heard me say earlier, moving back to Australia for 2 years, right out COVID from over there. And I am certainly going to keep my 529s for my girls, even though the growth on that might not be treated so nicely by the ATO, as we're about to see. So the ATO look at these types of accounts. They say, listen, we don't know what this is. We don't know the difference between a 401k and a Roth 401k or a 529. It's all, It's all double Dutch to us. So we're going to treat it as a foreign trust. And all we know about foreign trusts is that we tax the growth. The corpus of the account, the body of the account, is the contribution made by the employee, i.e. you, and or the employer if applicable. Everything else is taxable again. So you'll probably see why I'm not crazy about these types of accounts, because you've already made that contribution with after-tax money. You did that with the hope that that growth would be tax-free and come out tax-free. Well, not so much fun when you end up having to pay tax a second time to the ATO. That's why we don't like them. They don't travel well, as I like to say, a bit like lithium batteries. Don'ts in the US, short-term residential real estate. This is the one where I've done a case study. Now, please bear with me. It's 9 o'clock for folks on the East Coast, and it's just gone 6 o'clock on the West Coast. But stay with me here. Okay, short-term real estate, and I've used a holding period of 2 years in the example that I'm about to get to. But you heard me say earlier, I tend to be conservative with other folks' money, and so if your holding period's really less than 8 years, you might really give it a long, hard think, unless you're exceedingly bullish about the growth of real estate in that particular market that you're looking at. If you do have a capital gain, you will want to live there for at least 2 years to get the full amount of that exemption. $250,000 for single filers, $500,000 for married filing joint. One thing I really don't like about the US is and real estate is the transaction costs. They're horrific. As you see here, an article from The Economist last year, and they show that really you're talking about Russia and China, and only some of the time, I mean, their range is huge compared to the US, but look at that nice tight range there on the US side, and you're paying anywhere from, I'm guessing that's high fives to about 6% on your transaction. Now, I always enjoy reminding folks that that this is interesting, because if you compare that to what a stock trade is at Schwab presently, that's exactly $0. So the transaction fee is $0 or 6% of the entire asset value. So that should give us some pause. But I think I've done a decent example. I will accept questions or criticism, constructive criticism. Be nice. I have feelings too, with how I've done this analysis, but I think it's really fair. So expenses to consider. You've got property taxes in the US, significantly higher than what they are in Australia. Although I am loath to recommend investment real estate in Australia if you're in the US. I've done a couple webinars on that one, so check that out if you're in that situation. But we're not talking about that. We're kind of talking about the opposite here. Property taxes, they get higher in those states I mentioned earlier that don't have income taxes. There's often homeowners association if you're in an apartment or a community. Homeowners in a closed community. Homeowners insurance, repairs, of course, those are universal. But let's take a look at this case study. So if you went and bought a property for $1.2 million compared with renting the same thing for $4,000 a month, let's see how this shakes up. Okay, you got to put 20% down. So you got to pony up $240,000 from somewhere, and you don't have to technically. I just had a neighbor that moved in, a good friend of mine, my old neighbor, he moved out, and he mentioned that my new neighbor moved in with a 3% down payment. What that tells me is that they are paying mortgage insurance, an unnecessary expense if you can put 20% down. Okay, so let's look briefly at how this analysis shakes up if you lived in the same property with the same amount of growth for 2 years versus 8 years and achieve a small gain of $40,000. So let's quickly run through it. What do we see here? You've got some purchase costs. You do an inspection or two. You buy it for $1.2 million. That gets added to your total out-of-pocket purchase price. There's your cash down, your $240,000, your 20% deposit. There's your realtor's fees. Congratulations. There's a 6% paid to them. So your basis, it's only above that level that they're calculating a capital gain. And as you heard me say before, single filers that have lived in there for 2 of the past 5 years, it's $250,000 capital gain exemption and $500,000 for married filing joint filers. So we're not too worried about paying capital gains on this until we see quite a significant appreciation of the property. And we're not talking about that here tonight. Okay. When we go to sell, we see that $40,000 gain. So 2 years later, the market's gone up a tiny little bit, really just the amount of inflation. The agent takes their fee. Thank you very much. Selling costs, you had to spruce the place up, throw a new coat of paint. The carpet needed to be redone. So there's $5,000 in selling costs. So the amount you realize after everyone's been paid is $1,160,600. You have made a little bit of headway in your mortgage, 2 years of principal reduction. Congratulations, you walk away and you've made $1,000 on that property, having held it for 2 years. But did you? Let's have a look. All right, next page, we're comparing it to the $4,000 per month rental situation. Okay, first off, this is the buying scenario. This is the point of this particular table you see here is I'm trying to say what's your out-of-pocket cash costs, and you've got your principal and interest. There's your mortgage payment, $4,068 a month, and I modeled this very reasonable assumptions, 3%, 30-year mortgage. That's what it's going to cost you. Throw in some property tax of $1,200 a month, $200 for homeowners insurance, other costs $250 for that accrual for repairs. And you're looking at $5,718. Now that's an interesting number because it's exactly $1,718 more. Excuse me, it's not. It's $1,600 and what is that? $88 more than the rental equivalent here. So there's a difference in your monthly cash flow. Yes, you own it. Yes, you participate in the upside of that property. But you're also having to shell out close to $1,700 a month more to own it. So if we look at that difference there over a 2-year period, assuming these facts and circumstances, that's a $40,000 difference in cash flow out of pocket. 40,515, lo and behold. And we'll get back to those numbers in just a minute. So really the bottom line here is this: what did you actually lose? What's called the fancy word the economists use, your opportunity cost of capital. What could you have done had you not had to come up with $240,000 to put down as a deposit? What could you have done if you did not have to pay $1,700 a month more just to service your mortgage and pay your property taxes? Well, here's what you could have done. You might have earned $24,600 on the 240 that deposit. The 240,000 invested at 5% compounding growth for 2 years would have yielded you to $24,600 before you paid some taxes. And the difference in the cash flow, the 40,500 that we just saw a minute ago, had you invested each one of those $1,700 monthly payments, the difference in payments, that would have yielded you $43,269 if invested also at 5%. So the total difference that we're talking about is $67,869. But remember, you did make $1,000 when you sold the property. So $66,800 and what's that going to be? $36. Interesting. Now, I'm not making a case one way or the other. You heard me say, I fumbled to find the word, but nuance is it? Is everyone going to experience a $40,000 gain? No. But right now, in coronavirus, if you happen to own an apartment in New York City or San Francisco, you would be very lucky to experience such a gain as that. But everyone's situation is different. Now, let's look at this and just see how the facts would differ if you'd held the same property for 8 years. And this is that conservatism in me when dealing with clients' money. Really, the only difference in this, we can make it real quick, because the only difference is we've paid the mortgage for 8 years. We've paid the mortgage for 8 years. And then if we look at the gain on equity, it's $138,000. In this instance, I haven't done the side-by-side and said, well, that's all well and good. $138,000 is nice, but What if you'd invested those $1,700 every month and you'd invested that $240 at the outset? How would that have shaken up? Well, we're not going there today. But you can see that the margin for error on the growth of the property does tend to even out by virtue of paying off that mortgage over time. Thank you for that. Next, illiquid partnerships. This is really quick, and that's kind of the negativity implicit in that word illiquid. It almost says it all. Illiquid, meaning you ain't going to get your money back so easily. Unlisted or illiquid REITs or other kinds of investments. There's a whole variety of them out there. Equipment leasing. One of my favorites, and by when I say favorites with air quotes, I mean least favorite, was a timberland REIT, which you can imagine is kind of the ultimate in illiquidity, because if those trees aren't ready to be harvested, then they're not worth nearly as much. Turns out, as it happens, that the timberland REITs are even worse than that, in that you don't actually even own the timber, you just own the land that the timber is grown on. But that's a whole nother story. Another thing to avoid: fancy alternative investments. The amount of money spent on these the marketing of liquid alternatives blows my mind. I mean, the number of luncheons and webinars and sales contests that they have for advisors that receive commissions is deplorable. High fees and poor historical performance. I've never touched them because they've never passed the sniff test to me. So steer clear. Self-directed IRAs. I love debunking self-directed IRAs because it's so easy to do. Someone who feels that they've found some sort of backdoor deal on the internet, a loophole that no one else has ever heard of, might be in for a rude surprise when we go through this. So the first thing is, if you are having to employ leverage, you've got some problems, or you probably have problems. There's a much higher cost of debt. So as we heard a moment ago, you could probably refi, if it's an owner-occupied residence, you could probably refi your home right now or get an original mortgage for about 3%, 3% on a 30-year property. If you're going to get a mortgage on a self-directed property, if you can get it at all, because in many states where there are non-recourse laws, you might not be able to get it at all because the bank says, well, we can't get it back because we can't sell it. Therefore, there's no security on the loan. Let's put that aside for a minute. If you can, in fact, get financing, that financing is coming in at 2 or 3% more. So we're talking 5 or 6%. For those kinds of interest rates. And furthermore, your deposit has got to be more significant. All right, not sounding very attractive so far. You heard me say this. Loan must be, any loan must be non-recourse. They can't go after the IRA. That's hence why they're looking for these higher down payments, because they want to be able to get their money back if this whole thing goes south. Only your equity is tax deferred. So that amount of ownership or growth, if you were to sell the property, that's attributed to the loan, let's say, let's use a 30-70 just to keep the numbers even. Let's say you put 30% down, $300,000 down on $1 million property, $700,000 was financing, the property doubled in value to $2 million. So of that gain, $700,000 was from the financing. That ain't tax deferred. You're having to pay taxes on that amount. Only the 300 that doubled would be considered tax deferred. Unrelated business income, and then there's a whole bunch of other issues here. You can't use it. What's this? An IRA owner cannot buy or sell to themselves. That would be self-dealing. That's a disqualified transaction. Lack of liquidity. Remember, at age 72, you have to begin paying what the government giveth, the government taketh away, in the form of required minimum distribution. So you have to pay, it's about 1/28 of the asset value from age 72 and thereon, because remember, as we saw earlier, these retirement account payments are ordinary income tax. So how are you going to give away 1/28 of your investment real estate property? It's going to be a challenge. Fair market value is going to be reported frequently. Oh my God. So now you're telling me not only do I have to pay the custodial fees of these self-directed IRAs, but I have to get annual valuations. Okay, I think I've popped that balloon. Next, maybes in the US. And these ones, they're either, I say, strong yeses or strong nos, depending on the circumstances. Of course, cash flow positive real estate. Who is ever going to turn that down? If it's a great deal, I've thrown some numbers together here on a spreadsheet. If you're earning 9.74%, by gosh, that's a lot better than earning 0.6% in your high interest, so-called high interest savings account at the bank today. So if I was in Australia and owned investment property, and then I would be okay with dealing with the additional tax filings, the property management hassles across time zones and different systems. That would compensate me and a client for that inconvenience. So that could make sense, but again, it's about doing good analyses, and your time is worth money. So don't forget to account for your time, unless, of course, your hobby happens to be calling up on tenants and posting ads and contacting property managers in a foreign country. Annuities, maybes in the US. You know, annuities is a tough one. We don't have nearly enough time to get into it. As funny as this may sound when I first describe it, annuities are kind of, they remind me of dogs in a way, in that dogs, you know, they can be tiny, they can be big, they can have all sorts of different colors, hairs, you know, hair types, abilities, whatever. Annuities are kind of like that. They just vary so much. The particular annuity that I really like, I like longevity annuities, otherwise known as deferred income annuities. And I think you will too once I explain it to you. And let me see here. Someone's popped in with a question here. Karen Fogarty, is any more of this relevant to Americans living in Australia? Long-term, never want to return to the US? Yes, it is. Why? Just stick around another 5 minutes and I think we'll be done. So longevity annuities, here's what we have here. The way it works, super duper simple. You contribute a sum of money to an insurance company. These are the companies that write these things, insurance companies. And then you wait a period of time, typically at least 2 years, and congratulations, they pay you an income stream. They send you a paycheck every month for as long as you live. Typically, you wouldn't look at one of these annuities until you're in your later years because of the compounding effects that we're about to talk about, which is what's called here mortality credits. Let's get straight to it. Mortality credits, it's an interesting phenomenon. It's actually very, very old. It's a financial innovation that's hundreds of years old. They used to be called tontines. Now they call them longevity annuities. The way it works is like this. If you were in a pool, if there were 1,000 other annuitants, is the word that they use, 1,000 other annuitants, and we were all 75 and we're saying, great, I'm going to start taking payment from my deferred income annuity at age 80. That sounds like a great plan to me. Well, guess what? Not everyone in that pool of 1,000 at that age is going to make it to age 80, sadly. What happens with the money that they have contributed to the pool? Well, lo and behold, that gets contributed to the survivors, the people that actually at age 80 were there ready to collect their annuity payment. And that's what, in simple terms, that's what a mortality credit actually is. So what we see here is the amount in basis points. Basis points is a fancy word for fraction of a percent. So we could think 0.35 of a percent, 0.52. You start to get up into these older ages, 75 and 80. That's, I think, around that point is the sweet spot. You're seeing a yield increase of, in the case of 75, 2.37% and 4.14%, a massive boost to otherwise very, very, very conservatively managed investments. What we see here, thanks to Michael Kitsis, who did this study, if you bought one of these things at age 65 and you took it at age 65, you don't get any increase as a result of your mortality credits. If you bought it at 65, took it at 75, look at that, bang, you've seen a massive increase. If you bought it at 65 and distributed at 85, holy mackerel, look what you've done. There's a gigantic 455% increase. So I like them, but why are they on the maybes list? Because you'll have to talk to your your tax attorney or CPA to figure out how that would be taxed for you, Karen, if you were back in Australia. I love them, but I don't know necessarily. That one has not yet come across my desk in terms of how that's going to be taxed by the ATO. All right, last maybe I've got for you tonight is cash value life insurance. If you're in the US, and don't do this in Australia. So maybe, Karen, this is the time to log off. Cash value life insurance, it's an interesting one. As I would say, it's the last good place to go if you're a high income earner in the US here. What gives me pause about these assets in the first place, these cash value life insurance policies, very different to term, very different to term. The thing with a permanent life insurance policy is it's a completely different risk to the insurance company. With a term life insurance policy, we're saying, what's the probability that the insured is going to die in this window? And if you're a healthy, let's say 40-year-old, to use my example from earlier, if you're a healthy 40-year-old, it's really unlikely you're going to die in the next 10 years. Now, maybe that's changed with COVID, but I'm told not much at all. But anyway, that's another story for another time. Whereas if we're talking about permanent life insurance, what's the probability that you're ever going to die? Really, really, really likely. In fact, so likely we could say that it's a certainty. And so that changes so many things about how these things work. It's more of you could think of it almost like a savings plan in a way, with a slight growth value to it. So the other reason I rarely see a need for people to get permanent life insurance is your insurable needs tend to decline with age. Kids grow up, mortgages get paid off, retirement gets saved for. The estate tax these days is so high, you'd really better be well heeled to worry about estate taxes. And it's the last good place to go. I've got a client, he got one back in 1988. And it's great. I told him something I rarely say when I see these. So I said, this is a fantastic policy now that you've had it in force for 30 years. It's paying a dividend of 5%. I love it because there's so much cash value. He's overcoming all of the expenses built into this thing. It's not unlike a rocket shooting up. Elon Musk comes to mind. A rocket shooting up into space. It needs to go really fast to escape those gravitational forces, pulling it back to Earth. It's a lot like these permanent life insurance policies. You've got to overfund these things to help them escape that gravity of the expenses pulling this thing back down to Earth, which is not to say it can't be done. It can be done. It's just the last good place to go. Okay, so in my hierarchy of places to go, you'll see the variable annuity there, a no load note. That means no commission. Have to shop high and low to find those, or work with a fee-only advisor. And cash value life insurance is at the top. So what is good? I've kind of issued a whole bunch of, watch out for this, that, and the other. What is good about them? Growth is tax-free, and you can structure them to get loans out tax-free. That can be a really cool feature, and could be a great asset to have. In a down market, Wade Pfau, one of the leading academics in the world of retirement research, in fact, he has a website called Retirement Researcher, he points to home equity lines of credit and cash value life insurance as being what's called a buffer asset. In a down market, you take from these kinds of accounts and you don't have to turn a paper loss into a permanent loss. That's about it. I think we're running up against time here. I was just going to provide my commentary. It's looking more and more likely that Biden's going to win. That being the case, I hold to my thesis that I think the exchange rate is going to continue this decline that's commenced since the beginning of September. Of course, it's not going to be a nice, smooth, even line, but I predict it's going to keep going down, and probably will be down, I would say, by the end of the second quarter next year. Australians' recovery is hinged on that, none of which look especially good. Interbank spread. Be careful how you do foreign exchange. For my clients, I've negotiated a rate that's 1/6 that of TransferWise, which means thousands of dollars if you're sending over lots of money. All right, Diane, she writes, I've moved to the US and have an Australian whole life insurance policy that I that I'll be cashing out in 2021. Should I take out a term life insurance policy in the US? I am 66 years old. Diane, what a fantastic question. That would completely be determined by your situation. Do you have an insurable need at all? Why get life insurance? You get life insurance because mostly, not always, but mostly because there's someone that you love that you want to care for and make sure that their condition, their standard of living doesn't radically alter with a breadwinner no longer being around. Okay, that is my answer to that. I'm going to wait for those questions here, and I won't say what I was going to say. I'll just keep waiting here. But while I wait for those questions, because it takes a moment for people to type, I will mention we do have 2 white papers that you can access from Arete-WA. Don't be fooled if you go to Arete-WS. That's focused more on domestic clients. Shall soon be going away. We've got 2 white papers there. PFICs, Passive Foreign Investment Corporations, makes for good bedtime reading, but basically don't do them. And the pros and cons of managed fund investing, where we spent a lot of time drilling into that Morningstar report. If you want to get in contact, that's how to do it. But we have had 2 questions come through. Andrew writes, can you talk a bit about inheritance impacts on cash value life insurance? Also, strategy to avoid step-up tax in case of Biden victory. Okay, can you talk a bit about inheritance impacts on cash value life insurance? Well, to be honest, there's not much to talk about because when a death certificate is presented, the insurance company pays the death benefit, and that's that. The contract, to put it very nicely, has matured, and at that point in time, it's done. So there's no step up on basis. There is no basis really because it's cash. It's received to the beneficiary as cash, and that's that. Also, strategy to avoid step up tax in case of Biden victory. Not sure what is meant by that. Step up. I don't know. If you can elaborate, I'd be happy to. I mean, a 402k. For a 401k, yeah, I would be surprised if that happens. To be honest, all sorts of things get bandied around to get people energized about these things, but I don't see it. Can I use Lisa Ann writes, can I use a 529 to pay for a PhD at Melbourne Uni? Well, that's a fine question. Depends where you are. If you are in the US and you funded that 529 before you left, you're in Kansas City, okay. Presumably you've been funding it for a long time. I'm not sure. Let me 1 second here. Let me look at my handy dandy cheat sheet of 529 tax deductibility and look at Kansas State. Good news. It does look like there is a state tax deduction for making that contribution in the first place. That's a wonderful news. We like that. You've been contributing for 10 years. Then in all likelihood, yes, you could in fact receive that and pay no capital gains tax on that. On the US side, I guess I would be cautious to pay that before you arrive in Australia. That way it's very clear that you were a US tax resident at the time that you paid that tuition. All right, next, Corey Hugh here writes, if you have a cash value life insurance policy in the US and you pass in Oz, is the benefit tax free if the beneficiary is also an Aussie? That's a great question. By gosh, I don't know the answer to that. I don't think it differs, to be honest. I'm strongly inclined to say it doesn't. It would pass tax-free. Strongly inclined, of course. Go seek your own tax advice, because I'm not a CPA, and you'd be foolish to act based upon what I'm saying here, given that I've told you go to talk to a CPA about that. But the cash value itself throughout life for the owner of that policy, that's where some tricky tax issues come in. But as far as the beneficiary is concerned, I'm quite sure, I'm actually almost nearly certain that is tax-free. Okay, questions are rolling in. Colin, how you doing? What is your recommendation for converting US dollar funds from US accounts to Australian and transferring to Australian accounts? Who offers the best exchange rate, lowest markup on interbank rates? Well, you're in luck, because I put that table together right there, which answers that question for you. TransferWise and OFX will do you about the same. They're coming in at 60 basis points. Clients of mine get that 0.1, which is 1/6 of that. Or you could go to Interactive Brokers yourself. There's nothing stopping you from that. And that truly is the best out there. But Interactive Brokers is not the easiest to work with. Let's just say that. There's a reason they're as inexpensive as they are. And you never would have thought that you're paying for customer service until you don't get any at all. Brett Villagrand writes, is there an advantage of living in the US as an Aussie, that is, i.e., while owning real estate okay, that's going to need some unpacking there. Is there an advantage of living in Australia as an Aussie while owning real estate or cash in Australia? Of living in the US, is there an advantage of living in the US as an Aussie while owning real estate or cash in Australia? No, I actually, sorry, I don't know why. Maybe it's 8:33 and at night, but no, I tend to be pretty bearish on that. The cash is, you're gonna have to file FBARs, possibly FATCAs. You just added to your tax return. Is unless you were particularly bullish on the strengthening of the Australian dollar, you're earning the same interest rate in Australia or worse than what you're getting in the US. And then on real estate, go watch my other webinars on that. Terrible. I think it's terrible if you're holding it for investment purposes. If, however, you're holding it for use purposes, then maybe it's not so bad. Christine, hi Christine. If you're an American living in Australia, would you be best off having your own business or being an employee? That's a fine question. Taxes and deductions. Wow. I tend to, on the US side, so I'm not really answering your question here. On the US side, I have a strong bias to being a business owner, being an independent contractor at a minimum, given the flexibility, the way that Internal Revenue Code is written, all of the goodies and giveaways for business owners, very few for employees, sadly, and that may have contributed to the political situation that we have these days. But that's another comment for another time. But as for being an American in Australia, that gets tricky. I would say it probably still does, because that would be one of the situations where you might be able to get money into a 401k and where it might still make sense. Tommy, we're cruising through here. Regarding your point on PFIX, does that apply to salary sacrifice to Australian superannuation? Ooh, that's a tough one. Gosh, that's a good question, Tommy. Does that mean salary sacrifice should not exceed what the employer contributes? Yes, it does. I think you know exactly what you're talking about by that question. The magic threshold that most reputable CPAs and tax attorneys will tell you is that it's to do with the 50% contribution level. So if you've contributed more than 50%, it's going to be deemed as a foreign grant or trust, and therefore be subject to other control or other issues of control come into it, and you could get hosed, in which case the PFIC veil that is not there the PFIC protections that are there when it's deemed an employee trust, when you've contributed less than 50%, are not there when it's a foreign grant or trust. Let me see here. I'll swap over to the chat panel. Katrina, hi Katrina. She writes, are you familiar with QRPs, qualified retirement plans, I presume? I am Australian living in the US and use it for wealth creation. I love them. Great. I don't know what they are, but that's good to hear. Andrew, can you avoid the corpus of a 401k or IRA portfolio by rolling it into a family trust? I haven't heard that one. Lisa, thank you. It's always nice to hear that. Andrew, no, I haven't done what that's about. But here's the thing, is the beauty of the tax code is you can shop around and get any answer that you want, but it is like going out on the spectrum. There are folks that would tell you that certain things are possible, but like I said, reputable ones say that such tricks, the tax treaties were not designed so that treaty folks that use the treaty pay no tax. They were designed to avoid double tax. So if you're abusing it, thank you, Andrew. If you're not paying any tax, then I think the IRS is coming after you with a stick. And we'll hear about this Dixon case towards the end of the year, and have much clearer understanding on some of the more avant-garde strategies that have been employed to get around paying some of these taxes. Jeff, if you have a Roth, is there something you should do with them, such as withdrawing capital before moving to Australia? Yeah, probably. That would be the 5-year rule. The thing with Roths, I wouldn't get too worried about them, even though they're undesirable from a overseas point of view, in large part because most people don't have very large balances in there. So if we think about the taxes that would be due, it's really not going to be much. Remember, if you've held it for 5 years and you're under the age of 59.5, the only penalty tax you're paying is on the growth. I'm talking about in the US. It's only on the growth anyway. So yes, it's ordinary income plus 10%, but given that these are small account balances to begin with, it's really not something to get too worried about. Brett, I'm gonna wrap it up here with when I get to Chris's question. No more after that. Brett, if we decide to live in Oz and the US 6 months a year, will I have to pay taxes in both countries? What about health insurance? Brett, without knowing whether you're a US person or not, I cannot answer that question. Excuse me. The other thing I couldn't answer is 183 days. 6 months isn't accurate enough. The US has a substantial presence test, and by which you would be deemed a US tax resident, regardless of, like I said before, if you were here with no legal status at all. Corey writes, can you take a tax-free policy loans for a US in-force cash value policy if you've moved back to Oz? I don't know the answer to that. Probably not. The tax treaty doesn't deal with cash value loans. I know exactly what you're talking about, Corey. I think the ATO would be hip to that, and there would be something in there. I don't know that to be a fact. It might be an out, but generally, there's a reason why they say life insurance is sold and not bought, and that's one of the reasons. And last question here from Chris. Thanks for putting these talks together. Thank you, Chris. I appreciate that. As a newly relocated Aussie resident, most of my wealth is still in the US, sitting in Vanguard primarily right now. What options would I have to go about buying Aussie property? Well, what a fine question. That would mean getting that money out of the US for starters, as fee efficiently and tax efficiently as you could, and getting it back to Australia, and then talking to you know the rest. I don't want to. I don't want to be smart here, but talk to a mortgage broker and get that done. For clients of mine, I should mention that we have a deal, and I'm fee only, as I mentioned. So this is why it's a deal. There's a finder's fee paid to me by a mortgage broker in Australia, which I refund to clients. So clients of mine end up getting a better deal than they could get even in Australia by virtue of that. Let me see here. Chris Adams, cheers for answering your question. Hey, thanks so much. I'm going to get home, and I hope this was informative for you. If so, there's only one thing I ask. One thing, please don't keep me a secret. I do this to help other Aussies out there, and then every now and again, someone says, by gosh, I think Ashley might be worth talking to about helping me with my situation. All right, everyone, have a wonderful evening. So long.